Thanks everybody for joining. I'm Megan McGuire. We've got Sim on the call and a few other consultants with us to answer some questions today. We will get started here in a moment. All right. Do y'all see anything in the Q&A section?
Yeah, lots of folks coming in from all over.
Lovely. Well, we will get started here shortly. A couple housekeeping things. The Q&A section is open for folks to ask questions. Maybe please hold on questions until we get through this conversation, because I'm sure I'm going to answer a few of those things as we continue through this conversation. We will have some folks answering questions in the chat, and then we'll answer some questions live. I'll go through a real live file to show you how we do like an analysis of a double consolidation case. So, but do you want to introduce yourself, Sim? And we'll kind of go down the line.
Hey everyone, I'm Sim Terwilliger. I am one of the senior consultants here at SLP, Student Loan Planner. And today we're going to be going over some information for Parent Plus loans and some deadlines to know about.
All right. We've got Sam and Angie on as well. If you guys want to say something, go ahead.
Hello. Happy to be here with you guys.
Yes. Looking forward to answer some of your questions, but Megan knows everything there ever is to know about Parent Plus loans. So listen up, because you're talking to an expert.
Thank you. Well, I'm super excited. So I'm Megan McGuire. I guess I'm the resident Parent Plus expert, really, because I just have done a lot of these consultations before, and I like to nerd out about this stuff. But Parent Plus loans are extremely, well, I should say they are more complicated compared to student loans that your kids can borrow for themselves. So I'm definitely aware of that. They're more complicated in the sense of trying to get access to these cheaper repayment plans. They are, in a sense, more limited initially. So today we're going to talk about this double consolidation strategy that you've read about, you've probably heard about, answer live questions, go through an example. So the Q&A section is where you can drop questions. You can drop them anonymously, or you can have your name show up, and we will try to get to as many as possible today. We'll answer some in the chat, just typing and verbally. So with that, I think we'll go ahead and get started, right, Sim?
Let's do it.
All right. So let's talk about Parent Plus loans and strategies. So who are we? Just a quick recap of who we are. So we're with Student Loan Planner. I would say we are the experts in student loan repayment. We're a team of a lot of financial professionals. So you'll see a lot of like letter soup, alphabet soup up here. But CSLP, that stands for Certified Student Loan Professional. CFA, CPA, and CFP. You've probably heard those designations in the financial planning space. We're a team of very educated professionals in the financial planning space that have chosen to specialize in this area, student loan repayment. And we've advised over 15,000 people so far with our team. We have about 33 people on our team, I think, right now, maybe a little more now. We've advised on over $3.2 billion in school debt. There is trillions of student loan debt outstanding. So we still have a lot of work to do. And we've had a projected about $872 million in savings that we've saved folks in their student loan plan over time. So we are super excited to chat with you guys about student loans, something no one wants to talk about, but especially Parent Plus loans. So let's maybe start with a general rule of thumb. So this is how we can maybe frame our mind on what bucket to put yourself in, and if you even need to be entertaining this double consolidation idea, or income-driven forgiveness at all, because some of you on this call might not even need to do this. So let's go ahead and filter you in a bucket. And it has to do with where your balance stands in comparison to your income. So if your student loan balance is less than your annual income, what you're going to have in retirement, then you probably want to treat these loans like a regular debt pay them down more aggressively, pay them off sooner rather than later. That's because mathematically, you are going to pay them off if your balance is going to be a lot less than your future retirement income. Now, that's not always the case. There are certainly exceptions to these types of things, but this is a good rule of thumb. Now, if the reverse is true, if your Parent Plus balance or your federal student loan balance is a lot greater than what your annual income is going to be in retirement, you should be looking at an income-driven plan, and you should probably be entertaining this double consolidation process that we're going to be talking about today. So taking a passive approach. These income-driven plans that we'll talk about, they have the ability to make your payment based on as little as 10% of your income. So 10% of discretionary income compared to the plan that you normally would have access to with Parent Plus loans, which is 20%. So that's a big difference, 20% payment going down to 10%. That's a pretty big difference. So these are the buckets to filter yourself in. If you're someone whose balance is going to be probably greater than income, then we want to be treating these loans more passively and going towards loan forgiveness. Anything you'd like to add there, Sam? Does that make sense how I explain that?
I think that makes sense. And maybe you guys have heard of this. This is kind of jargony, but we call that your debt to income ratio. So that is, how does your debt compare to your income? And that's what we're talking about today in these two paths that really any borrower has. You only have two paths as far as how you're going to tackle your loans. So you're either going to pay them off or go for some kind of forgiveness.
Mm-hmm. Yep. So let's talk a bit about Parent Plus loans in general. So what are they at their core? So Parent Plus loans are federal student loans that you can borrow for your child that's going to undergraduate, an undergraduate degree. So a bachelor's degree, and they have to be under the age of 24. So you can borrow up to the cost of attendance for each child. That cost of attendance is dictated by the school. So that could be a lot. If the school says the cost of attendance is $50,000 a semester or $50,000 a year, you can borrow up to that in Parent Plus loans. There's not a normal credit check like there would be with a regular private student loan, in the sense of like telling you how much you can borrow and giving you an interest rate based on your credit. They're really just looking to see if you had any other, negative debt on your profile, any federal debt outstanding, but that's it. If you don't have any of those, like an active bankruptcy or federal debt outstanding that's in delinquency, you're going to be able to borrow a Parent Plus loan for a child who's going into an undergraduate program at a school that allows for Parent Plus borrowing. So this can get expensive because you can borrow the cost of attendance for each child. If you have 5 kids, that can really add up. So the only way to access loan forgiveness for Parent Plus loans is consolidating. What I mean by consolidation is combining the federal loans within the federal system. So this is not the same as privatizing or taking the loans to a private company. Consolidation keeps the loans federal, and that's what gives us access to driven repayment plans. And the legislation has only given Parent Plus loans that have been consolidated access to a plan called income contingent repayment, or ICR. That's that 20% of income that we've been talking about. So this again is not a lot of times much relief to anybody because it is still a large payment calculation for most people. And why this is a growing topic is because Parent Plus loans are the fastest growing of all types of student loan debt right now. That is because undergraduate programs are getting more expensive. There's more kids going into college programs and needing to borrow, and Parent Plus loans are very accessible. So you guys are not alone. I want to say that too. Like, you are not alone with these Parent Plus loans. It is a growing part of the student loan system.
And I'll add one thing too, Megan, is that we get this question a lot. Is there a way that I can transfer these loans to my child? Legally, you are on the hook for these. So regardless of like whatever, informal arrangement you have with your kid, like I'm going to borrow and you're going to pay it off, legally, you're still on the hook. And the only way to get your child on the hook is if they do a private refinance, which brings it out of the federal system and it takes all of these forgiveness options off the table.
Mm-hmm. Yep. So if we're someone who needs these income-driven options or a forgiveness option, refinancing is a no-go. We do not want to do that. So what is the double consolidation? So this is what we're here for today, right? So the double consolidation, let me first say that this is a loophole. This is not something that you can call the loan servicer and ask them to help you to do. They're probably not even going to know what you're talking about or know how to do it. So a double consolidation is basically a way to open access to those cheaper income-driven plans we've been talking about, the SAVE plan, the PAY plan, the IBR plan. So 10 or 15% of your discretionary income. So in the language of what brought about Parent Plus loans, it said that if you consolidate a Parent Plus loan, then it will only have access to income contingent repayment. It'll become a direct consolidation loan that will only have access to income contingent repayment. But there is no limit to income-driven plans if there's two consolidations that have been consolidated together. So I'm going to go through a visual of this because I know verbally talking about this can sometimes make our head spin. But so that's to come. I definitely will go through a visual here in a second, but I'll re-explain that. So when we have a bundle of Parent Plus loans, let's say we have 4 Parent Plus loans, we can consolidate them separately. So let's say we bundle 2 of those loans together at one student loan servicer, and we take the other 2 and we bundle them together at a different student loan servicer to just keep them separate. We have 2 direct consolidation loans at that point, which what did they do? They consolidated Parent Plus loans. So those 2 direct consolidation loans still just have access to income contingent repayment. But the key here is when we consolidate those loans together, we combine them together. And what we've done is we've consolidated 2 direct consolidation loans. We haven't consolidated Parent Plus loans at that point. So in a way that tricks the system into allowing access to those cheaper repayment plans, SAVE, PAY. So that can make a big difference in someone's budget, someone's forgiveness timeline, someone's forgiveness total cost when we're looking at repayment of federal student loans. So the SAVE plan, this is the newest plan on the block. This plan is cheaper than any of the plans available, today, any of the other plans available. It has forgiveness after 25 years of repayment, which does seem like a long time, but if we're looking for an affordable payment with some kind of end in sight, this could still be a really great option. And then whatever is left over after that 25 years of payments is forgiven. What's very important about SAVE is that it does not allow interest to accrue. So, I'm in a room with a motion light. Let's see if I can get it to turn back on. You want to pick back up for a second?
Yeah, this is just to check to see if you guys are paying attention. But yes, this consolidation, so Megan's going to go through an example. This can actually be done with as few as 2 loans, because you can do a Parent Plus loan by itself. So you don't need to have a lot of loans to do this. And we get this question a lot too about, should I have the loan stick around for 25 years? A lot of people in this situation, this may apply to a lot of you guys, are going to retire soon, so your income might drop. And so you're looking at potentially even $0 payments possibly. So imagine, what you'll use that cash flow for, that you're saving, that you're not throwing at your student loans.
Mm-hmm. Yep. I hope that made y'all laugh, me being in the dark. It might happen again. I'm going to have to push the chair in front of the sensor later. So yeah, this is a very significant strategy to make payments affordable, because what is kind of crazy is that you can borrow, again, as much as the cost of attendance allows, which can be very problematic when we're looking at this from a traditional payoff approach, like a traditional amortization schedule. That payment can be massive compared to what you're actually earning as in income. And when you go to retire, that income might be less than what your active income was when you were working. So this can be a way to make repayment affordable long-term, to where it's not something that you have to drain all of your retirement assets towards. So what is the cliff that we're talking about here? That was kind of the title of this presentation. So the Parent Plus cliff is the fact that this loophole is closing. So it's kind of interesting because this being something that's going to get closed in the future also legitimizes it. It is a legitimate loophole that we can take advantage of until July 2025. So that in a weird way was like a positive thing because it confirmed that, yeah, we could definitely do this. It's kosher right now. But it's a bad thing in the sense that we do have to get this rolling for people who need to take advantage of this before July 2025. So if you already have Parent Plus loans or you're almost done borrowing Parent Plus loans, great. We're going to be in good time. So any double consolidations finished after this date, so let's say that final consolidation in the future is after July 2025, it is not going to have access to those cheaper plans, unfortunately. It'll limit you to that income contingent repayment plan. So that's the only option available after July 2025. So what could happen is, I know some folks will have kids that are graduating in the midst of this timeline. Maybe kid 1 is graduating next year, but kid 2 doesn't graduate until 2026 or 2027. We can still take advantage of the double consolidation for the loans that are available to consolidate before this deadline. And then the loans that are borrowed after this deadline, they'll still have access to that income-driven plan, income contingent repayment, and you'll have a weighted payment based on like the weight of how much has access and how much doesn't. So overall, it'll still be a lower payment if you get the ball rolling on the loans that are available before this deadline. So we are advising, don't plan on loans that are borrowed after January 2025 to be part of this double consolidation process. And that's because consolidations take time to do. They take 30 to 45 days to complete. So if we have to do 3, technically, sending 2 bundles elsewhere and then 1 bundle together, that's going to take between, I'd say like in the shortest, it'd be like 4 to 6 months. So this time is not quick. This process is not quick, unfortunately. So that's why we're saying, if you have any loans borrowed after January 2025, go ahead and count on them being only eligible or only having access to ICR. So this is an example of just an idea of the impact of the double consolidation, like getting access to those cheaper plans. Let's say we have about $100,000 salary or maybe income in retirement between pensions, Social Security, 401k withdrawals, whatever. So about 100,000 coming in. Let's say we have 200,000 of Parent Plus loans. So that's double what our income is at the time. Remember, filtering yourself in a bucket, that means we should probably be taking a passive approach going towards loan forgiveness. So if we just had access to income contingent repayment, that monthly payment for someone on $100,000 of income in retirement would be $1,400 a month. But if we did the double consolidation, that same income would generate a payment of $560 under the SAVE plan. So quite a big difference. Less than half of what it would be if we didn't have this loophole. So pretty significant there. And we can also get pretty interesting with saving more money by considering filing taxes separately. There's, loopholes within loopholes, if you will, there to help save as much as possible. So, but that's to show the impact. And then one thing worth mentioning, this IDR waiver, the IDR account adjustment that's been talked a lot about. This might come into play for you who have been making payments on Parent Plus loans in the past, or your own loans that you still have. So the IDR waiver is allowing all prior payment periods to count towards this income-driven forgiveness timeline. This is huge because let's pretend you've got a loan that you've had since, early 2000. It was for like your master's or something, or your own degree. And then you borrowed Parent Plus loans later on, starting in like 2015, 2016, and you're done borrowing now. So you have two sets of loans, your own loans and your Parent Plus loans, and you have two different payment histories on each bundle of loans. Your loans has a lot of payment history since early 2000. The Parent Plus loans, not so much because they just didn't exist, to have a lot of payment history yet. So this IDR account adjustment, how this is super significant is all of that time on your older loans can count towards this 25-year forgiveness timeline that we're talking about on an income-driven plan, even if you weren't on an income-driven plan. And if those Parent Plus loans are consolidated with your loans, we'd want to do that carefully because we don't want to taint the loan and make it only have access to ICR. But if we did it in the right way, then that whole balance would have the same payment history that that oldest loan had. So that could speed up your timeline significantly to forgiveness. So that's a pretty aggressive example, but I see a lot of this where like you as the parent have your own loans that you're still paying back. They do have payment history associated with them. And if we consolidate before the end of the year, then that whole payment history can be credited to the whole consolidation loan with the highest payment history. I mean, starting next year, it'll be the weighted average. So it won't erase payment history in the future if you consolidate loans with different payment counts, but it will be the weighted average. So it's not as helpful if we have different payment counts there. Another thing to note is deferment and forbearance can count. So let's say you've had loans for a long time, but you've been in forbearance for a long time too. Maybe those payments were really overwhelming. If we have a certain number of months of forbearance, either consecutively or aggregately, 12 months consecutive or 36 months aggregately, then those months can count towards the income-driven forgiveness timeline too. So I bring this up because I know there's a lot of parents out there who have had loans for some time, and you're probably not starting from scratch on your forgiveness timeline. So that 25 years might not really be 25 years. It might be a lot less when we take a look at your loan file. Do you like to add anything to that, Sim?
Yeah, so this consolidation business with the IDR waiver is actually a really big deal because before the waiver, it used to be that if you did a consolidation, it would like totally wipe your credit to zero. And so temporarily that's not the case. And like Megan said, starting next year, they changed it so that it won't reset to zero anymore. But now it's doing this wonky weighted average. And if you're not sure what a weighted average is or how to calculate that, it could be worth it to, have someone, shameless plug, take a look at your situation and do the math for you.
Mm-hmm. Yeah. And I will maybe take a step back too and say that a lot of these terms and things that we're talking about are pretty complicated. We literally have designations to help us learn this like legalese and these like financial planning terms here. We know this is like Department of Ed data. There are so many borrowers who have been in repayment for 20 or more years. That could be some of you guys. You could be within like 5 years of forgiveness here. So this is definitely something worth taking a look at and getting some help with if you're unsure like how to take advantage of this IDR waiver in conjunction with this other pretty complicated topic of Parent Plus loans. So here's some actionable steps, and then we'll go through some Q&A here in a moment. So what should we be doing now? Let's start to simplify things, and then we'll go through an example and some Q&A here. But first, we need to figure out if you need to be doing a double consolidation or not. Is it worth your time to do it? Does it make sense mathematically to do it? Maybe not. If your balance is quite small compared to your income, this is probably not going to be worth the effort. You're going to be paying this off anyways. But if you're in the other bucket where your balance is a lot greater compared to your income and your retirement income in the future, then we probably have self-certified that we need to do this process. So step 2, I will also acknowledge that this is a process. This is a lengthy process, and we're working against servicers that are kind of, this isn't a normal process, I'll say. So patience is super important throughout this time, because it can take, again, 4 to 6 months, maybe at the soonest, to get this all done. And we're working against, servicers that right now are very overwhelmed because payments have recently restarted. So third is we need to figure out, do we qualify for employment credit? We talked a lot about income-driven forgiveness a moment ago, but this also relates to public service loan forgiveness. So if you've been a public servant, working as a teacher, working in a nonprofit setting, a government setting, state, city, local, tribal entity, public service loan forgiveness could be very real as well for you. That's a program that forgives your loans after 10 years of payments working at an eligible employer full-time, 30 hours a week at least. So all the things I was mentioning about this IDR waiver a minute ago also apply to PSLF. So if you've been working in public service and you've been paying on your loans, even if they're Parent Plus loans, we might need to look at consolidation before the end of the year to take advantage of getting you credit for PSLF. Otherwise, we won't have that credit next year. And then lastly, we need to figure out if you should switch into the new plan SAVE. There are a lot of income-driven plans. There's maybe 2 that we might narrow it down to if we're doing the double consolidation. We might be looking at Pay, which also IBR, new IBR could be considered, or SAVE. There are 2 plans that are the cheapest from a payment perspective, but they have different terms that might lean one way or another for us to consider. SAVE is 25 to forgiveness, 25 years. Pay and new IBR is 20 years. It's a little shorter, but the monthly payments are more expensive and it doesn't have the same interest subsidy. So we'd want to maybe consider like which plan exactly we want to go on here. So the SAVE plan, I'll touch on these little points real quick, and then we'll go into those examples and those Q&A or like live Q&A questions we have. So payments for the double consolidated loans, for folks who have Parent Plus loans doing the double consolidation, we do think that the payment's going to be based on 10% of your discretionary income. The language on the SAVE plan seems to be pretty clear that 5% for undergraduate loans only applies if they were your undergraduate loans. And these Parent Plus loans were your kids' undergraduate loans, not yours. So we're pretty confident that, after this whole process, your payment will be based on 10% of discretionary income. But if you do have some of your own undergraduate loans from the past, those will be based on 5%, and you'll get a weighted average between like how much of your balance was which. The poverty line deduction is larger on SAVE. That just means that they subtract more from what they're going to consider as part of your income when they calculate your payment. That's why it's a little cheaper than what the old repay was and what pay is. The forgiveness timeline is 10 years if we're working in public service. It's 20 years if we only have undergraduate loans, which if we have Parent Plus, they're not going to be considered undergrad. And it's 25 years with our Parent Plus loans or graduate loans. So we can file taxes separately to keep the payment off of just your own income. This is that loophole within a loophole I was mentioning, where we can exclude your spouse's income. If you're the only one who has the Parent Plus loans, we can exclude spousal income to keep the payment off of just your income to keep things cheaper. The interest subsidy, this waives any accruing interest on the balance. So what this means, just in simple terms, is let's pretend your interest accruing each month or that's charged on your balance is $1,000, but your payment on SAVE is $200. That means $800 of interest goes unpaid. And so that $800 on the SAVE plan is waived. So that's what a subsidy means. It waives the accruing interest on the balance. So that means your balance doesn't move. It doesn't go down. but it doesn't go up. So, and then one thing to note, if we are on the save plan, we can't switch out of it after being on it for 5 years. They're trying to prevent people from switching to the 20-year plan after being on save for like 19 years. And then repay doesn't exist anymore. It's being replaced by save. So I'm going to pause. I know we threw a lot of just factual details at you for a moment. I'll pause so Sim can read some of the like common questions coming in the chat, and then I'm going to work on pulling up an example in the background.
We have hundreds of questions in the chat right now, so I'm skimming through and I'm going to pull out what I'm seeing as kind of commonly asked questions. So for PSLF, your loans need to end up with Mohela. They are the servicer for the PSLF program. Even if for some reason, you know, you're doing the double consolidation and you don't choose Mohela as one of the servicers, you can still get the loans to end up there when you do your employment certification form. So no biggie, we can get them there. Another question I'm seeing a lot is a little bit of confusion between PSLF and then the income-driven plans themselves. So when we talk about these two paths, what do I do with my student loans, pay off or forgiveness? Within forgiveness, we have two paths themselves. One is PSLF, 10 years, public service, tax-free forgiveness at the end. The other is within the income-driven plan itself, 20 or 25 years like Megan talked about, depending on what plan you picked. And then for some folks, so I know we were talking about how save is like a really big deal right now. And for a lot of people, it's a great option. But for some of you, depending on what your income is going to look like, if you do an income projection, those extra 5 years on save might actually be very expensive for you. And you might be better off doing something like pay as you earn or new IBR. And so that's one thing to consider. The other thing to consider is that pay as you earn is going away in July. If you switch off of it, you will not be able to get back on it. So we have some folks who switched plans and maybe their payment went up because their income has gone up. So even if it makes sense for you to eventually end up on save, it might not make sense to switch right away if you have a really low payment right now. Let's see what else is coming through in the chat. Someone's asking, when consolidating, can you add someone as a co-signer? They don't have co-signers when you're doing the double consolidation, or they shouldn't. What happens if you don't qualify for save IDR? So as long as you have direct loans, you will qualify for save. That's the only requirement, is that you have direct loans. Some of the other loan types, like if you have like FFEL loans, those don't qualify for save unless you do a consolidation, direct consolidation. Someone's in the process of the double consolidation and it's going to be a while before it's done. They want to know, what if they can't make the monthly payment right now? Can they request a lower payment option while waiting on the consolidation, or that mess up the consolidations in progress? So technically the loan servicer is supposed to place your loans into administrative forbearance. And so you shouldn't have to make any loan payments. If for some reason they didn't do that, you have a couple of options. One is you can actually try to call them. I know wait times are criminal right now. You can try to call them and request a forbearance, or you can do it online. There's paperwork you can fill out to request a forbearance. We also have something special right now called on-ramp. Because payments have been turned off for 3.5 years, you know, it's going to be difficult for some folks to start making payments again. And so to prevent people from going into default, if you don't end up making a payment, they will retroactively place the loans into a forbearance status. And that way, if it gets reported, it shouldn't get reported, but if it does get reported to the Credit Reporting Bureau, it will not show up, at least as far as, you know, the government's concerned, as delinquent. Okay. Great question here. I will be well into my 70s when the 25-year period ends. What happens with my taxes and forgiveness at that point? So the way it is right now, that forgiveness at the end, if it's not through PSLF, is going to be taxable. This is an IRS thing where anytime you have debt that's forgiven, and it's not just student loans, it's any kind of debt. Anytime you have debt that's forgiven, it is treated as earned income. So if you hypothetically get like $100,000 forgiven, the IRS treats it as if you just happen to get like, you know, $100,000 in income. That's the way it is right now. But during COVID, they got rid of what we call the tax bomb, right? Because we hate it so much. They got rid of the tax bomb through the end of 2025. And so there's precedent that, you know, they can get rid of it. Will they get rid of it again? There's some speculation, you know, that they might, because honestly, you're going to have a lot of people over the next couple of decades getting forgiveness on these plans. It's going to be very unpopular politically to start charging, a bunch of people in their 70s, 6 figures of, taxes on their forgiveness. So I always like to kind of encourage you, call your congressperson and say, look, you guys did this before. You got rid of the taxes during COVID. Can you extend this? So that's my little plug to go ahead and do your civic duty and advocate for yourself. That's what your tax dollars pay for right now. Okay. Just skimming through some questions here. What happens if I consolidate a couple of years ago? So there's, I saw this question a few times. So what if you did a consolidation, but you did not do double consolidation? So I think we'll be talking about this in a little bit. We lovingly call this strategy, grandma goes back to college. So you may need to go back to school if you want to. And if you want to try to finish this process out and borrow some loans to try to do the process right. So we'll touch on how to do that in a little bit.
Perfect. Well, I think I've got an example.
You got an example. All right, we'll stop Q&A for now and circle back.
Yep. Thank you. So let's see. Okay. So I want to visually show folks how to maybe think about doing this consolidation, this double consolidation here. So this is a file that we use in our consultations that helps us analyze the data of somebody's loan details. So what's important for us to look at here is, how many loans do we have? One. So this person has 8 Parent Plus loans. Pretty common if you had 2 kids that you put through school, because you have 1 Parent Plus loan per year. And so what we would do in this case, what I meant by kind of bundling loans together is we would basically combine these loans together here. Let's say we just bundle the more recent 4. We bundle the older 4 together, and we consolidate those 2 separately. So these loans are currently at Nelnet. So I get a lot of questions too about which companies do we use, and do we have to use different servicers? The answer is yes, we do have to use different servicers, because if you just, sent these applications to Nelnet, if you sent 2 separate applications to Nelnet, consolidating these 2 different bundles, they would look at them and they'd say, why don't we just combine these together? And that's what they would do. They would combine them together. And if you didn't notice that they did that, then we no longer have the ability to do the double consolidation. So again, we're working up against a system that this is not designed for. This is a loophole. So there's not a great process for this. So we do need to send it to different servicers, but we can use the existing servicer that we have if we want. So for example, we could send this bundle to Nelnet, and we could send the second bundle to a different servicer. So some of the servicers out there, there's Nelnet, like on here, there's AidVantage, there's Mohila, which also has consolidations done by AidVantage, and there's Ed Financial, which is also, they process the consolidations at AidVantage. So you're going to run into these 4 main companies, 3 of which are touched by AidVantage. Is that a problem? No, it's not. They do have separate PO boxes that you mail these letters to, or these applications to. So we just really have to use a different one for each consolidation process. That's what's important. So let's say we consolidate these at Nelnet. We send these to, let's say, AidVantage. Those go and consolidate by themselves. It takes probably 30 to 45 days. And what you end up with is 2 separate consolidation loans at those 2 different companies. And then we turn around and pretty much immediately consolidate those 2 together. And we consolidate those 2 together at a totally different company. So let's say we wanted to go to Mohila. That could be the last servicer that we send the consolidations to. Now, paper consolidations. So I think you guys are aware, we do have to do, I suggest doing paper applications initially. And the reason is you can only do 1 online application every 6 months. So that limits our time. Like if we only did an online consolidation for 1 bundle every 6 months, we'd be knocking on the door at the timeline that we're risking not being able to have access to this. So the paper applications initially allow us to get those out simultaneously to speed up the timeline. And they can go and bundle, at the same time. And then we can do the online application for the last process. So that's typically how I suggest doing it. A lot of times people will just have 4 loans. So you'll split them 2 and 2. Another big question I get is, hey, I only have 3 loans. Can I consolidate 3? Can I do this with 3 loans? And the answer is yes. One Parent Plus loan can be consolidated by itself. I know that sounds kind of confusing, but one Parent Plus loan can be consolidated by itself. It converts into a direct consolidation loan, just like it would if it had another loan to consolidate with. So that's also, so how many do you have to do this? The minimum is 2 loans, 2 Parent Plus loans to do this. So that's some visuals for folks. I've got maybe another example we can go through here in a bit, but I'll turn it over back to you, Sim, to do some questions, and we'll circle back to me.
We have lots of questions about the logistics of doing the double consolidation as well as PSLF. So like Megan just said, you can do one Parent Plus loan by itself, but you need at least 2 to do the double consolidation because you need to have another loan to consolidate it with. And you can do any plan, any income-driven plan counts for PSLF, but we're talking about trying to get you on the cheapest plan. So that's why we would do the double consolidation. Can I consolidate an old loan that now has a 0 balance? No, it has to be an open and active loan. Will we be able to consolidate on paper by the December 31st deadline? Because we have loans that we have been paying for 9 years already. So the deadline's pretty tight. We're in November and it can take 30 to 45 days just to do one round. And so kind of depends on your risk tolerance. There may be yes. I would say it's probably good to get a second set of eyes on it and see what makes sense for your situation. If you're really close to PSLF, maybe it's not worth the hassle of trying to do the double consolidation. In some cases, it makes sense just to do a regular consolidation, get on income contingent repayment just to make sure we get all of that credit applied, and then just finish out that last year on a maybe more expensive plan. So it's a very case-by-case thing. Okay, I'm just scrolling through.
All right, I've got one more I can bring up.
Perfect.
So let's see. This is going to be an example of someone who had lots of other payment history and loans of their own. Okay, so you may be in a situation where you don't have just Parent Plus loans. You could have some of your own loans. You might also have a lot of Parent Plus loans. So the paperwork, I'll show you the paperwork right after this. The paperwork has limited spaces on how many loans you can list on the form. There is an additional loan sheet that you can add to add additional loans that you need to do the double consolidation with. But anytime there's any extra work for the servicer to look at, it makes me nervous. So sometimes I would suggest consolidating the bulk of Parent Plus loans. So this person had already, let's see, we had a combination of their own loans and Parent Plus loans. So in this situation, I'd probably suggest consolidating all the Parent Plus loans actually. So that might freak people out because I'm saying, hey, we're consolidating them all together, but we have other loans in the picture here. So we consolidate all the Parent Plus loans into one direct consolidation loan. And then the other loans are eligible for consolidation already. So we can consolidate those together, and we've still met the definition or done the right thing with the language here where we haven't consolidated Parent Plus loans on that last consolidation. So this is something that you could do. You can start with an online application if we have lots of loans, because that'll simplify the paperwork quite a bit by just combining, most of them. You can leave a couple out and then do the consolidation on paper in this example, it would be adding all the Parent Plus loans together, doing the paper consolidation application to consolidate the remaining 3 that were left, and the Parent Plus loans that we consolidated before. So this can get very complicated. I definitely realize that as I continue to talk. But so one thing to know is we do have some free help on our website. I'll pivot to that real quick. We have an article that I wrote about this whole process on our website. So there's an article about the process. I have a YouTube video showing people how to do this. And we do have the consultation service. So that's something that we have available to help you walk through this, because again, this is a lot. I mentioned that because there's a lot of things that can go wrong with this double consolidation, right? It's a loophole. It's not guaranteed. I can't guarantee that it's going to get done right. I will say that I don't think I've had anyone fail, going through this process with us. It does work if the process is done correctly and if it's monitored correctly. So it's a loophole. The servicers, though, are often very much uninformed or overworked or busy. And so they speed through things. They deny things initially that should have been approved. You have to call them. Like, it's not an easy process. So if you're doing this, it's because it's saving you a lot of money. We're going to have to work for it, though. So I just want to tell you all that.
Let me throw in something too, Megan, that because we are hearing from so many people that servicers, you've done the double consolidation correctly and they still won't take you off of ICR. So your options are either call and talk to someone else, or, and I wrote a blog post about this, actually, you can file a complaint. And there are different ways to do that. I think the best ones are really the Consumer Financial Protection Bureau or the constituent services of your local congressperson. You can also reach out to the Student Loan Ombudsman.
Mm-hmm.
But when in doubt, I'd probably start with the Consumer Financial Protection Bureau, because it requires whatever the entity is that you're complaining about, they have to respond within 60 days.
Mm-hmm. Yep. And sometimes it is fixable by a phone call with a rep that cares enough to listen to you a little longer than maybe the other rep that you talk to. And I am finding that if we mention the double consolidation when we're calling about a problem, like if they initially denied you for an income-driven plan, if you call and explain that you did the double consolidation, that phrase almost has a little trigger now where they say something along the lines of, oh, hang on 1 second. And then they go back and they talk to their manager and they come back and they're like, oh yeah, you're right. I'll get you set up. So you're going to run into this. If this was easy, everyone would know about it. Everyone would be doing it. Everyone would be saving money. It's not easy, but if it's going to save you a lot of money, it's probably worth it. So it might be a little bit of a process, maybe a little stressful, and if you want the help, if you want someone to help you through it, we can help with this process overall. So, cool. So let's go back to questions, and I'll help a little bit in the Q&A as well. And I'll maybe pop back up.
Yeah, we just had one about interest rates. And when you do a consolidation, what is the interest rate? So that, I think there's some confusion because some people think it's like a refinance where when you do a consolidation, you get a brand new interest rate that's related to like the rates of today in the economy. That's not what they do. They actually just take a look at your current interest rates. They'll do a weighted average and round to the nearest 0.1%. So, and it's fixed. So it's not going to change after that.
I do want to mention the grandma goes back to school again.
Oh yeah.
So what that means is, let's say you're someone who consolidated all of your loans together already, and you are trapped on that income contingent repayment plan. Are you out of luck? Yes, if you don't do anything. There is one way, only one way that you can get out of that and have the ability to do the double consolidation. And that's and it's going to sound silly, but it's to enroll in a college course. You might have to take at least 2 classes, finish the semester, and then you'll have a loan to consolidate. If you borrow for that semester, you'll have a loan to consolidate with the remaining loan that you have left. Because unfortunately, you cannot consolidate a direct consolidation loan by itself. Now, I know we can with Parent Plus loans. We can consolidate Parent Plus loans by themselves, but we cannot consolidate a direct consolidation loan by itself. So you're going to have to go get another eligible loan. Doesn't matter what you enroll in, doesn't matter if it's basket weaving or, whatever, you might be interested in. But we just have to have that loan to consolidate with the balance. Now you're going to have to do this by either this upcoming semester. So, spring semester coming up, summer semester of 2024, or fall semester. So you only have 3 chances to maybe do this if you have already consolidated and you're trapped in your in your ICR plan. So that's what we mean by sending you back to school. But that could be a way to get access to the double consolidation. All right, let's see what other questions we have. Man, there are a lot of very detailed questions too.
Yeah, if you have like really specific questions, you might want to book a meeting with us, because sometimes we can't know for sure until we look at what is your income or what we think your income might look like in the future. How many years of credit are you going to get by doing the double consolidation?
Mm-hmm. Yep. So, and I will say too, like we are a team, so we do have more availability now. We've got a lot of folks that can help. We do these one-on-one customized plans. So not only are we going to talk you through like the double consolidation, but we'll help you figure out like if you should be filing taxes separately with your spouse, or give you an estimate on what your payments are going to be, what that potential tax implication could be for loan forgiveness. So we really do put together a full custom plan for you to help make sure that you know what to expect and you're able to plan for this. We definitely are, the ones out there being quoted on this process. We are the experts in this process. So if you need the help, there is the free resources online, but if you want the one-on-one customized attention to make sure that it's being done right, we are definitely the ones that can help you through that process. So let's see, we've got 5 minutes. So let's maybe find a couple tricky questions, or a couple like common interesting questions, and then we can close out for the night. Let's see.
Yeah, this is an interesting one about PSLF. This person says that they work as a contractor for a company that qualifies for PSLF, but they are not directly employed by that company. Will they qualify for PSLF by doing the double consolidation? For PSLF, you have to be directly employed by the qualifying entity, 501c3 nonprofit, government, whatever. Unless you're one of those in one of those states like California or Texas, where you are directly prohibited from working for the qualifying entity. Like if you, like, for example, are like a Kaiser physician, which by the way, we're seeing some Kaiser physicians who have to do the double consolidation and can get PSLF when that's done. So it's a very specific situation.
Mm-hmm. So questions about PSLF too, like if you have not, so this is probably important. So if you are doing the double consolidation, you don't want to submit your PSLF paperwork until this double consolidation is done. So that's important, because if you're sending the loans to like Nelnet or a different servicer, the PSLF application is going to pull them to Mohila, and we don't want them to be pulled to Mohila prematurely. So if you need to complete the double consolidation, do that first. And then the last step will be submitting the PSLF paperwork to claim credit for that prior work history. And after 2024, they're going to give you the weighted average of your payment history. So that's definitely better than nothing. When in doubt, submit an employment certification form for PSLF. Like if you think your employer qualified, go ahead and submit to find out. That's on studentaid.gov. Again, all of this is very nuanced. It's a very nuanced process. So, it's meant to be kind of a PSA, general information for everybody. And, hopefully, I think we're going to be here for help if you need some one-on-one help with your specific plan. And we also have our article and our YouTube video about the process online on our website. So let's see.
Someone was asking about income driven repayment. If their income goes down, what happens to their payment? Is it fixed? So it's not fixed since it is tied to your income. If your income goes down, you can ask them to recalculate your payment either by giving them something like a pay stub that shows your lower income, or if you like lost your job, you can tell them you have no taxable income.
I did mention that I'd show you guys the online or the paper application form. So let's see. Actually, I thought I had it pulled up, but so you can Google this paper. Let's see if I can find it real fast. Consolidation, Department of Ed. So you could just Google this. You need to find the PDF version though, if you're starting this process. So this is what it looks like. It has some information that you have to enter on the front page, which is a lot of basic information. This is the second page where it asks you which loans you want to consolidate. So you're going to find the loan codes, the loan holder information, the loan account number, and the estimated payoff amount on your studentaid.gov portal. So studentaid.gov is a wealth of information. You'll need to log in. Once you log in, you can see the loan details of each individual loan. And that's where you can gather the information for these paper forms that you're going to have to submit. Follow the instructions on that YouTube video. If you're doing this on your own, it should help you get through it okay. And let's see, we are exactly at time. Any closing thoughts that you want to round us out with, Sim?
Yeah, for those of you who are maybe thinking of borrowing for your children, I just want to kind of give you permission to remind yourself you got them to age 18. And if you can't pay for their education, there's nothing wrong with that. Just, you know, be confident in the person that you raised. They can take out scholarships, but there's nothing wrong if you, you know, can't help with that. And there's nothing wrong if you decide with your kid that they're going to refinance the loans into their name. Sometimes that makes sense, and we can help navigate that conversation.
Awesome. Well, thank you guys for listening in today, participating in this conversation. It's a heavy topic. I know this is not a fun conversation. I hope you were able to take a couple nuggets of information with you today to hope clear up maybe some mystery about this process. We've pointed you in the direction of some resources to have some help with some of these things. If you've already done a consultation with us in the past, we do offer follow-up consultations. So you can reach out to who you worked with previously or schedule a follow-up to review your plan if you need to make some adjusting. But we are here for you. We definitely can sympathize with maybe the pain and anxiety you feel around these loans. This is what we do. Our bread and butter is student loan repayment. So all of our consultants will, definitely be able to help and walk you through this and help you see to the other side of this. But thank you guys for taking time out of your evening to listen in. And I think that's about it. Awesome. Well, thank you guys. Sorry we didn't get to all the questions. Hopefully we were answering a lot of the main general questions. You could also email help@Student Loan Planner for other general questions. But I hope you guys have a great evening and thank you so much.